Stop everything you're doing right now. Close your laptop. Kill the Bloomberg terminal. Shut down every financial news app on your phone. Because in the next 25 minutes, I'm going to expose a lie so foundational, so deeply embedded in the precious metals market, that once you understand it, you will never make another investment decision the same way. The banks have been running a con for 40 years, and today we're pulling back the curtain. Every single time silver starts to move, every time the supply chain breaks, every time the physical shortage becomes mathematically undeniable, the same scene plays out on CNBC, Bloomberg, Fox Business. A so-called expert walks onto the screen, a strategist from Goldman, a chief analyst from JP Morgan, and they pull up a chart, one massive bar graph showing 300 million ounces of silver sitting safely in COMEX vaults. Look at the inventory, they say with absolute certainty. There's no shortage. The market is drowning in metal. The squeeze narrative is dead. Silver is plunging. And here's what happens to you. Your stomach drops. You look at your position. You see red. You think about all the research you've done, the supply deficits, the manufacturing demand, the industrial revolution in clean energy. And then you look at that 300 million number on the screen, and doubt creeps in. Maybe I'm wrong, you think. Maybe these experts actually know something I don't, so you sell. You take your loss. You move back to the safety of the dollar. This is exactly what they want. Because that 300 million number isn't just misleading. It's not just incomplete. It's a calculated, deliberate, mathematically fraudulent representation of reality, designed specifically to trigger your fear response and make you hand over your physical metal at a discount. And I'm about to show you exactly how they pull off this psychological operation. To understand the con, you have to understand the architecture of the COMEX vault system. There are two categories of silver sitting in those vaults, two completely different classifications that the media combines into one number to hide the truth. The first category is called registered silver. This is the only metal that matters. This is real inventory, real float, real supply. Registered silver has a warrant attached to it, a certificate, documentation proving that this metal is available for immediate delivery. You walk into a COMEX-approved vault with a futures contract in hand, and the vault operator loads the bars onto a truck. That's it, done. This is the inventory that gets traded. This is the metal that impacts price discovery. This is what moves the spot price up and down, and right now, it's collapsing. We're watching registered inventory drain at an accelerating pace, week after week, day after day. The numbers are approaching critically dangerous levels, less than 100 million ounces. Do you understand what that means? Less than 3 weeks of global industrial demand. 3 weeks. That's how much physical metal is available to settle every single paper contract floating around the global financial system. When you really think about it, it's almost comical. It's like a bank claiming to have liquid reserves when they actually only have 3 weeks of customer withdrawals backed up. That's insolvency. That's the definition of insolvency. But now let's talk about the magic trick. Let's talk about the number they use to hide this catastrophe: eligible silver. This is the artillery shell they use when registered inventory gets too exposed. When retail starts noticing the registered category dropping, they point to eligible and say, "Look, we have 200 million ounces. Everything is fine." But here's what eligible actually means, and this is critical. This is the entire con wrapped up in one definition. Eligible simply means the silver meets the purity standard of the exchange. It's a 1,000-ounce bar, 999 fine. It's stored in a COMEX-approved vault. That's literally it. It does not mean COMEX owns it. It does not mean the banks control it. It does not mean it's available for sale. It's private property, parked, held in custody, nothing more. Think about this analogy carefully because it's the key to understanding the entire con. Imagine a massive airport parking garage, thousands of cars. People pay monthly to park their vehicles there. The garage is secure, climate-controlled, insured. It's the safest place in the city to leave your car. Now the garage owner looks at his spreadsheet. He counts all the cars. He tells the city council, "This garage contains 50,000 vehicles. We have massive inventory. We are the safest parking facility in the nation." But here's the critical question. Does the garage owner own those cars? Can he sell your car to pay his mortgage? Can he give your car to someone else because he made a promise to them? No, that's grand theft auto. That's larceny. He goes to federal prison. The exact same principle applies to eligible silver. Just because the metal is sitting in a Comex vault does not mean Comex can touch it. The banks cannot seize this metal. They cannot steal from private owners to cover their naked short positions. It's against the law. If JP Morgan or any bullion bank tried to confiscate eligible silver to settle a delivery demand, it would trigger the greatest financial crime in history. Lawsuits would be filed in milliseconds. Criminal charges would be immediate. Every attorney on the planet would smell blood in the water. But more importantly, and this is what the banks fear most, the trust in the global financial system would evaporate instantly. No sovereign nation would ever store gold or silver in New York again. No family office would ever use a Comex vault. No mining company would ever deposit their refined metal there. Comex would cease to exist as a functioning business entity before the sun set that day. So the banks are trapped by their own structure. They can count the eligible metal. They can brag about it. They can point to it when retail investors get nervous, but they absolutely cannot touch it. This is the anvil hanging over their heads. When they combine registered and eligible into one number, that fraudulent 300 million, they're including metal that is legally, financially, and practically unavailable to them. They're counting a car in the parking garage as if they own it, the real silver float, the real amount of metal that can be sold to cover paper contracts. It's a fraction of the headline number. It's shrinking, and it's about to run out completely now. The fearmongers will try to calm your nerves with a legal argument. You see this constantly in YouTube comments, in Reddit threads, in financial forums. It doesn't matter if they run out of metal, they say. The banks will just declare force majeure. They'll cancel the contracts. Everyone will get paid in cash. This is the ultimate defeatist argument, and it's legally, factually, completely wrong. Force majeure is a contractual clause. It frees both parties from liability in the event of an extraordinary, unforeseeable event that is absolutely beyond human control. We're talking about acts of God. An earthquake swallows Lower Manhattan, and the vault collapses into the Hudson River. Force majeure. A nuclear weapon detonates over New York and vaporizes the financial district. Force majeure. The U.S. government passes an emergency law confiscating all silver, just like they did with gold in 1933. Force majeure. But you know what is absolutely, categorically not force majeure? Incompetence. Greed, recklessness, bad risk management. Selling 500 paper ounces for every 1 physical ounce you actually own is not an act of God. It's not an unforeseeable event. It's not beyond human control. It's commercial negligence. It's a business strategy that spectacularly, catastrophically failed. If a bullion bank walks into the Southern District of New York and tells a federal judge, "Your Honor, we need to declare force majeure because we sold too much paper silver, and now the price is too high, and we can't find the physical metal in the market," that judge is going to laugh them out of the courtroom while his bailiff escorts them to the door. Insolvency is not an excuse to void a contract. If you promise to deliver silver and you can't find it, you don't get to just walk away. You go into the open market. You bid aggressively. You pay whatever it takes. You find the metal, and you deliver it. This is where the trap snaps shut on the short positions. The banks are cornered now, completely surrounded. Option 1. Deliver the registered silver they promised. Impossible. There's less than 100 million ounces and they've sold promises for billions. Option 2. Steal the eligible silver from private owners. Illegal. They go to prison. Option 3. Declare force majeure. Illegal. The judge laughs them out of court. So what's left? There's only one move in the playbook. Only one option that doesn't end in prison or financial collapse. They have to bribe the eligible owners. They have to go to the private individuals who own that metal, the family offices, the wealthy stackers, the hedge funds, and make them offers they literally cannot refuse. Let me walk you through exactly how this plays out. You own 10,000 ounces of eligible silver. You bought it at $50. You stored it in a COMEX vault for safekeeping. You're planning to hold it for years. Spot price right now is $75. The phone rings. It's a trading desk from JP Morgan. "Sir, we need your silver. Will you sell it at spot? $75 an ounce." You laugh. "No, I'm holding long-term. Silver is going much higher." The trader gets nervous. "Okay, we're willing to pay a premium. $85 an ounce." You think about it. The inflation data is screaming higher. The geopolitical tensions are escalating. The mining deficit is undeniable. "No, not selling." The trader's voice gets tense. "What if we paid $95, $100? We really need this metal." And now you realize something. You realize you have leverage, real leverage. The bank is desperate. They need your metal. $150, you say calmly. "We can't pay that." "Then I'm not selling." This is where the squeeze mechanism triggers, because the bank isn't just desperate for your metal. They're desperate for everyone's metal. Every eligible owner, every private holder, every family office with bars in that vault. When delivery demands hit and registered inventory evaporates, desperation becomes panic. Panic becomes panic bidding. Panic bidding turns into price discovery based on actual scarcity. That's how silver moves from $75 to $200 overnight. Not because of trading volume, not because of technical chart patterns, but because of forced buying pressure from insolvent short sellers who have to cover at any price. The eligible owners become the market makers. They set the price, and they're not going to accept $75 when they know the banks are desperate. So the next time you see that 300 million ounce chart on Bloomberg, I want you to do something different. Don't be afraid. Laugh at it. That chart is actually a map of their own destruction. It's a visual representation of exactly how much metal is locked in strong hands. It's proof of exactly how much metal the banks cannot touch. The eligible lie is the final defense of a system that's running out of time. But while the New York banks are playing legal games with inventory definitions, something far more dangerous is happening on the other side of the planet. The real price discovery mechanism is waking up. Shanghai. Last Friday, just as the trading day was ending, just before the Lunar New Year shutdown, the Shanghai Futures Exchange sent a message to Wall Street. A message so loud, so mathematically undeniable, that it should have triggered emergency meetings in every trading desk from Manhattan to London. The Shanghai silver contract closed the week up 5.6%. When you convert that percentage into US dollars and strip away the currency noise, you get a price that represents reality. The price that actually matters, $86.70. Let that number sink in. Not $75, not $80, not $85, $86.70. Right now, if you walk into a futures pit in New York, you can buy paper silver at $75. But if you want actual metal in the world's largest manufacturing economy, if you want to buy silver that's going to be used to build solar panels, electric vehicle batteries, semiconductor chips, you have to pay $86.70. That's an arbitrage gap of nearly $12 per ounce. In a normally functioning global market, this gap would not exist for more than a few milliseconds. The moment the spread appeared, algorithmic traders would buy the cheap contracts in New York, sell the expensive ones in Shanghai, and execute the arbitrage until prices converged. But the gap isn't closing. In fact, it's widening. Why? Because the arbitrage is broken. Because you cannot physically move metal out of New York. The vaults are locked down. The supplies are constrained. The cheap silver in the West isn't actually available in physical form. It's paper. It's a number on a screen. It's a ghost. The expensive silver in the East is real. It's metal. It's atoms. It's being bought by factory owners who need it to build the products that power the world. And this creates a trap, a mathematical trap that the Western banks cannot escape. Shanghai closed its market on Friday and will remain closed until after the Lunar New Year. The dragon is sleeping. There will be zero trading coming from Asia for an entire week. The price is locked at $86.70 until the bell rings again. The Western banks are probably in panic mode right now. They're sitting in their boardrooms planning their move for next week. They want to smash the price. They want to trigger stop losses. They want to break retail investors' spirits while the big institutional buyer is away. They're probably planning to dump billions of dollars of paper contracts onto the market. They want to drive the price down to $50. They want to paint the chart red and terrify the weak hands into selling, but they face an insurmountable problem. If they succeed, if they manipulate the price down to $50 in New York next week, they're simultaneously creating a $36 arbitrage gap. Shanghai is frozen at $86.70. And when China wakes up from the holiday, when that bell rings, when the market reopens, there's going to be an apocalypse. Every trader, every algorithm, every factory owner, every industrial buyer in China will see a 40% discount to their local market. They won't just buy, they'll panic buy, they'll gorge, they'll drain every contract, every bar, every grain of silver that isn't physically locked in a vault. In a single trading session, they'll absorb every ounce of physical metal that the West has been hoarding. The COMEX vaults will experience a hemorrhage unlike anything in market history. The Western banks understand this. They see the trap. They're staring at that $86.70 floor knowing it's unbreakable. They know that if they push the beach ball too far underwater, the force with which it shoots back up will cause serious damage. So they're paralyzed, trapped in the kill zone between $75 and $86. Unable to cover lower because of the Shanghai floor, unable to cover higher because they're insolvent, stuck, waiting, praying. And this Shanghai Signal is telling us something that most investors refuse to understand. China is not afraid of high silver prices. For years, analysts said, "Oh, Chinese demand is price sensitive. If silver goes above $30, they'll stop buying. If it hits $50, they'll retreat." Every single prediction was wrong. Silver went to $50 and they bought more, went to $70 and they bought more. Now it's at $86.70 and they're buying at record volumes. They're not buying for profit. They're not buying for trading. They're buying for survival. They know what's coming. They see the currency collapse. They see the Western debt spiral. They're accumulating physical metal because they understand that it's the last real store of value. But if Shanghai sets the price floor, Shenzhen is where the actual physical metal flows through. And this weekend, the flow stopped. The system broke. If you've never heard of Xubei, let me explain why this matters. Xubei is a district in Shenzhen that is literally the jewelry capital of the world. It's not even close. 70% of China's gold and silver jewelry production flows through this small area. It's a place where metal trades constantly, massive quantities, cash changing hands every second. Dealers hawking refined bars, factories buying blanks to melt down. It's the lifeblood of the global precious metals supply chain. This weekend, Xubei became a crime scene. The Shenzhen Local Financial Supervision Bureau issued an emergency red alert. They launched a crackdown on what they called illegal gold trading activities. They're shutting down companies, seizing records, arresting executives, but here's what they're really doing. They're responding to a catastrophic collapse in the shadow market. A major trading platform called Zhurui completely imploded. This wasn't some small operation. This was a significant player in the Xubei market. A company that handled hundreds of millions in monthly volume, and their entire business model was a con. They ran a system called prefixed pricing. Here's how it worked. They'd approach investors, factories, retail traders, family offices, and make them an offer. Give us a 10% deposit and we'll lock in the price of gold or silver right now. You can take physical delivery later when you're ready. It sounded perfect, genius, even. You could hedge your metal purchases without tying up all your capital. Factories could secure their silver supplies for next quarter without paying the full price up front. But it was a Ponzi scheme. Zhurui would take the 10% deposits, leverage them aggressively, and bet that prices would stay stable. They'd use the new deposits to pay off the old customers who demanded delivery. It was a house of cards. As long as new money kept flowing in, the illusion held. But then volatility hit. Silver ripped to $120, then crashed to $75. The leverage positions blew up. The math broke. The pyramid couldn't sustain itself anymore. When customers showed up to Zhu Rui's offices to claim their metal, when grandmothers with their life savings came looking for their bars, when factory owners showed up demanding delivery for their production schedules, the vaults were empty. Completely empty. There was no metal. There had never been metal. It was all on paper. The company had spent the deposits on operating costs and paying off previous customers. It was a con wrapped in the legitimacy of a trading platform. Now the streets of Hubei are filled with protests. Videos are circulating on WeChat showing angry mobs outside the offices. Police in riot gear, people desperate for their metal or their money back. The Chinese government had to respond. They had to show they're taking it seriously, so they launched a crackdown. They banned prefixed pricing. They banned leverage trading in physical metals. They're shutting down the entire shadow market. But here's what this actually signals. If the shadow market in Shenzhen, the market closest to the refineries, closest to the ports, closest to physical reality, is imploding, what does that tell us about the legitimate markets? What's happening in London? What's happening in the Comex vaults? What's happening in the unallocated accounts at Western banks? They're running the exact same scheme. Selling you futures contracts with tiny margin requirements, promising metal they don't physically own, using new deposit money to pay off customers who want delivery. Zhu Rui collapsed this weekend. Comex hasn't collapsed yet, but the timer is ticking. The contagion spreading from Shenzhen is going to accelerate the destruction in New York. When Chinese factories can't source silver from Hubei because the dealers are in jail, they'll turn to the international market. They'll buy LBMA inventory. They'll drain Comex. They'll empty every vault accessible to them. The failure of the shadow market in China is a prelude to the failure of the paper market in the West, and we know exactly when this collapse is scheduled to occur. We have a date circled on the calendar, a date where every paper promise has to be converted into physical reality.